For this learning objective, we're going to determine the level of sales needed to attain a target profit. The Wind Bicycle Company's current contribution margin income statement is as follows. Notice we have a net operating income of $20,000. This is based on sales of 500 bikes at $500 per unit, variable cost of $300 per unit, which gives us our total contribution margin of $100,000. Once we subtract our fixed costs, we have $20,000 in net operating income. Earlier, we've considered how many units we need to sell in order to break even. Let's now look at how many units we would need to sell in order to achieve a target profit of $10,000. A $10,000 target profit means we want our net operating income to be $10,000. Since our fixed costs are $80,000, we will need a contribution margin of $90,000 to achieve this target profit. If we look at our per unit selling price and our per unit variable cost, we see we have a contribution margin per unit of $200. If we take our $90,000 required contribution margin and divide it by our $200 contribution margin per unit, we find we need to sell 450 bikes to earn our target profit of $10,000. We can confirm this by completing our income statement. $500 per bike times 450 bikes will give us $225,000 in revenues, while $300 variable cost per bike times 450 bikes gives us a variable cost of $135,000, which, once we subtract that from our $225,000 in revenue, leaves us with our contribution margin of $90,000, which, once we subtract our fixed costs, gives us our target profit or net operating income of $10,000. We could also calculate our break-even point in units through an equation approach, which is simply our vertical income statement laid out horizontally in equation format. Our unit sales will equal our target profit plus our fixed expense divided by our contribution margin per unit. Our target profit, recall, was $10,000. Our fixed costs were $80,000. So $90,000 divided by $200 per unit contribution margin gives us our 450 units in sales we need to achieve this target profit. Notice this is the same calculation we did in our contribution margin income statement format. We took our $90,000 contribution margin, which was our fixed cost plus net income, and divided it by our contribution margin per unit. Let's go ahead and look at another example. Lynn Corporation has a single product whose selling price is $120 per unit and whose variable expense is $80 per unit. The company's fixed monthly expense is $50,000. Solve for the unit sales that are required to earn a target profit of $10,000. Given our $10,000 target profit and fixed expenses of $50,000, we need a contribution margin of $60,000. On a per unit basis, our contribution margin is $40. That's our $120 selling price minus our $80 variable cost. If we divide our total contribution margin of $60,000 by our $40 per unit contribution margin, we find we need to sell 1,500 units to achieve our target profit of $10,000. We can prove this out by multiplying our 1,500 units by our selling price per unit and our variable expense per unit. Our sales revenue will be $180,000. That's $120 per unit selling price times 1,500 units, while our variable expense will be $120,000. This indeed will give us our contribution margin of $60,000, which, when we subtract our fixed costs of $50,000, gives us our $10,000 net operating income or target profit. We could also get this solution by using the equation method. In our equation method, we simply take our net operating income, our target profit in this case of $10,000, add to it our $50,000 in fixed expense, and divide that by our contribution margin per unit, and we get the same 1,500 units to achieve our target profit of $10,000.